From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
The Tax Day edition. I'm Joe Mathieu alongside Kailey Leinz in Washington. Yes, on this Tax Day in America, where we're trying to gauge the impact of DOGE cuts on the IRS, Kailey, as well as the future of tariffs. We're trying to fill in the blanks on both, and maybe we'll learn a bit more today. We can tell you that some 20,000 IRS workers have decided to take the buyout, making some people wonder what that will mean for returns.
Yeah, if there's less people to process the paperwork, what exactly will that mean? Especially knowing that the receipts will factor in ultimately to the X date, when the U.S. government will no longer be able to meet its financial obligations, which factors in, of course, to the ongoing budget reconciliation conversation in Congress. They're assuming the X date right now is late summer, August, September time period. If that gets pulled forward, though, it's going to make that work a lot more urgent. There'd
be some irony if DOGE cuts are, in fact, what hastened the X date, and that may be what they're dealing with. They're out of town, by the way, lawmakers, the next 2 weeks. It's going to be a minute. Yeah, lucky them. Before we find out what's going on, Donald Trump will be rounding out the first 100 days of his second term in that time. And we could learn potentially more about tariffs, but this investigation into chips and pharma is going to take a minute.
Yeah, the Section 232 investigation officially opened yesterday, although President Trump suggested he might have news on semiconductor tariffs in particular within this week. These investigations usually last, 270 days? So perhaps they're talking about a truncated timeline here.
I guess that's true. It's, of course, moving stocks all the while, and we'll be watching Wall Street for you here, including shares of Boeing, to see the president's accusing China of reneging on a deal to take some Boeing deliveries. They're not going to be doing any more business, it seems, and with a 125% tariff on plane parts, that may not be too much of a surprise.
Yep, the tit-for-tat trade war comes for Boeing as well. We'll have the latest on that this hour, of course, but let's get the latest on the markets, how they are reacting to all of this news, and check in with Amy Morris, who's here in Washington. Hey, Amy.
Hey, Kailey, thanks so much. After green on the screen all morning, yeah, you're right. Markets are pairing gains now. S&P 500 is little changed. It's down 1 point. NASDAQ down 0.1%, and the Dow is down about 0.1%. The 10-year Treasury yield at 4.31% and the 2-year yield at 3.82%. Now, all of this started with a rally in Wall Street's biggest banks. That helped lift the stock markets this morning, but investors are reacting now to headlines on President Trump's tariffs war. The Canadian government saying that it will allow automakers to import a number of U.S.-made cars and trucks without tariffs as long as the companies keep manufacturing vehicles in Canada. And the government of Canada said it would provide a 6-month reprieve on imports from the U.S. used in Canadian manufacturing, processing, food and beverage packaging, and certain items related to public health. The U.S. economy is expected to lose billions of dollars in revenue just this year because of a decline in foreign tourism and boycotts of American products. Arrivals of non-citizens to the U.S. by plane dropped about 10% in March from a year earlier. International travelers spending a record $254 billion in the U.S. last year. The decline in foreign tourism is attributed to increased hostility at the border and rising geopolitical frictions. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's get back to Balance of Power with Joe Mathieu and Kailey Leinz.
All right, Amy Morris, thank you so much. I am indeed Kailey Leinz alongside Joe Mathieu, who is back in Washington. But yesterday, our focus here in Washington was actually on what was happening in Argentina, where the Treasury Secretary, Scott Bessent, was and sat down for an exclusive interview with our colleague, Anne-Marie Hordern. And a really interesting part of their conversation, Joe, was when he was talking about the ongoing negotiations and what he really thought the hardest part of them would be. He suggested tariffs might actually be the easy thing to address. It is what he described as the insidious non-tariff barriers that he said is the demon that needed to be exercised. And I wonder if that's what's factoring into our understanding. Bloomberg's reporting today that Europe is not really getting clarity on the administration's aims here, as non-tariff barriers with Europe when it comes to the value-added tax and regulation are things this administration has been griping about.
How true. Really something to find a story on the terminal as well, that with this lack of progress when it comes to the VAT or whatever it is we're talking about, the EU is essentially suggesting that these tariffs are going to be in place for some time, maybe indefinitely, preparing for the worst. That's where we start right now with Bloomberg's Tyler Kendall, who joins us live from the White House. Tyler?
Yeah, hey Joe, welcome back. Well, Bloomberg News reporting that the European Union, the U.S. have made very little progress when it comes to trade talks. The EU's trade chief was here in Washington just yesterday. We know that he met with the USTR Jamieson Greer as well as the Commerce Secretary Howard Lutnick. And per people familiar with that meeting telling Bloomberg News, EU officials left with very little clarity on exactly what the U.S. needs to see in order for a deal to get done. We know that the EU had paused its planned retaliation, actually slated to go into effect this week in concert with the White House's 90-day pause on that so-called reciprocal tariff plan. But the sense per our sources is that the EU is bracing for very little reprieve when it comes to the so-called reciprocal tariffs, as well as those sector-specific tariffs that are already in place, including on steel and aluminum, as well as autos. The European Union has put forward at least some proposals that we know of, including that both sides should drop their trade barriers when it comes to industrial goods, as well as pledging that the EU will boost its imports of U.S. LNG. But at this point, we haven't seen any indications that the U.S. is taking those proposals seriously, even though we do know that President Trump has previously signaled that he would like to see energy potentially rolled in to a deal with the EU. We know last week, according to Bloomberg News reporting, that the European Union was putting together a so-called term sheet with some things that they might be willing to concede in these negotiations that include those non-tariff barriers that you were talking about, like standards and regulations. It remains to be seen, though, if they would go as far to include the VAT or the digital services taxes that this White House often points to, because as Kailey mentioned at the top there, Scott Bessent saying yesterday, tariffs aren't the difficult part of the negotiations. It's those non-tariff barriers that can prove more insidious, as he said.
Well, and I guess there's, at the very least, the idea that the EU's trade chief, Tyler, did get to sit down with the Commerce Secretary and USTR yesterday. Those conversations, at least, seem to be happening. I'm not sure the same can be said about conversations with China, as no one has yet to pick up the phone in Beijing, as far as we understand. And now President Trump's obviously upset with the latest from China, the halting of Boeing deliveries. He says on True Social today that they're reneging on a deal.
Right, just the latest tit for tat in what is an escalating trade war. Our statistics show us that China's forecasted to make up to 20% of global aircraft demand over the next 2 decades. So this really will have a significant impact in the marketplace going forward as we watch both of these sides escalate. Scott Bessent, in his interview yesterday, saying that the U.S.'s planned tariffs are not a joke, even though that's how it's been characterized by Beijing, with that now 145% total tariff in place. And when we're talking about who's not engaging, it's interesting to see who these countries are engaging with. This White House has repeatedly said that it is prioritizing those countries that are geographically close to China, like Japan, South Korea, Vietnam, India. These countries that Scott Bessent continues to reiterate that they are engaging with. But then, Joe and Kailey, look at the other side. Xi Jinping currently on a Southeast Asia tour, visiting countries like Malaysia and Vietnam, as he tries to shore up his own support to counter this White House.
All right, Bloomberg's Tyler Kendall live at the White House for us on this Tuesday. Thank you so much. And of course, not just any Tuesday, it's also tax day in the U.S. And as we consider what kind of actual revenue raiser tariffs will be in terms of import taxes that are charged, we have to consider as well all of the other tax revenue that is or is not coming into the Treasury's coffers as we wait for clarity on what the receipts this tax season actually looks like.
The administration has been telling a pretty good story about that, pushing back on the idea that revenue will be lower. In fact, we're up 3% in the fiscal year through March, according to the latest. That doesn't tell us what's going to happen the rest of the year, though, because we just found out 20,000 more workers, these are not probationaries this time, have taken the buyout offered by the administration. That follows more than 7,000 probationary workers being cut. Hard to quantify the impact.
Well, yeah. Does that mean that there will be fewer audits, for example, maybe encouraging some who are on higher income brackets not necessarily to pay all the taxes that are due? These are the questions that we have, and the kind that we'll pose now to Erica York, who is joining us here on Bloomberg TV and radio. She's Vice President of Federal Tax Policy at the Tax Foundation. Erica, welcome back to Balance of Power. When we just consider what Joe was just speaking to, the reduction in the actual force of labor at the IRS that will be processing everyone's returns as they come in, do you expect it's going to make a real difference in what the end receipt figure looks like?
We haven't seen that so far in the data. If you look at the filing season statistics so far, we're pretty much on pace with last year's tax year. The question, of course, will be what happens with all of the returns that people submit last minute before midnight tonight. Several million of those are likely to be sent in via mail with paper checks. So we really won't get the final answer on what the tax season looks like for a while yet. I don't anticipate, though, a huge sudden drop. I think the question of IRS hiring, IRS firing is a bit of a medium-term question as to what happens going forward with taxpayer service, with guidance, with enforcement, not this year, but in years to come.
Talked to the Deputy Treasury Secretary on Friday on Bloomberg TV, Erica, who pointed to the receipts, the actual facts here. Gross U.S. budget receipts for the fiscal year up 3%. This is through March to $2.26 trillion, according to the Treasury. Michael Falkander says that's a robust tax filing season. Could that, in fact, be the story?
It very well could be. And if we look at the tax gap over time and we look at how the U.S. compares to other countries, we're not like a major outlier. Most people pay their taxes. Most people pay them on time. Our tax gap averages about 15%. That's the difference between what the IRS estimates should be paid and what ultimately is paid after audits and follow-ups. And that's tended to be pretty steady. So I don't think we'll see, sudden overnight huge drops, but it may be something that plays out over time. Probably not this year, though.
Well, and this year, of course, we are facing down a kind of clock here with the debt ceiling that still needs to be raised by Congress. The Congressional Budget Office, Erica, obviously has suggested they think the X date will come sometime in August or September. But just how easily could that be moved up, knowing there's only so far the Treasury's extraordinary measures are able to go?
Yeah, that could be subject to change, especially as we see timing delays with tax payments related to natural disasters. So several states have extended periods for when they actually have to pay taxes, and some of those go out past that estimated X date into November. So you could see timing issues there where it's not that the taxes aren't being paid, it's just they're delayed because we also have this natural disaster tax relief that we provide through the tax code. So that could be one factor to watch and see how that could potentially move up the X date.
We've talked a lot about a wealth tax, Erica York, over the years. Now we've apparently narrowed this down to a millionaire's tax, is being discussed by Republicans on Capitol Hill and the White House. Our political team reporting that Donald Trump is actively considering these ideas. The House proposal specifically would set the new rate at 40% for taxpayers earning $1 million or more a year. What kind of impact would that have?
So that wouldn't be a huge tax increase relative to where that tax rate is scheduled to go. Recall that after the end of this year, the top tax rate is scheduled to rise already from 37% to 39.6%. So going to 40% isn't a massive change from there. What it is a massive change from, though, is the way we typically hear Republican lawmakers talk about tax cuts, which is lowering those top marginal rates so we boost incentives to invest and to work in the economy. Much better ways to raise revenue exist than raising marginal tax rates on work and investment, things like broadening the tax base, clamping down on itemized deductions, looking at types of income that just aren't subject to tax at all would be much more fruitful than something like raising the top rate even higher.
Okay, so if this is really just a marginal potential increase in the top rate, how far would it realistically go to offset other initiatives we understand Republicans are pursuing, like, for example, raising the cap on the SALT deduction or no tax on tips or overtime, programs that we understand could add materially to the total cost of this bill?
So it really depends how they design those other types of tax cuts. The full proposals that Trump campaigned on would add, $2 to $3 trillion to that cost when we look at no tax on Social Security, no tax on tips, no tax on overtime. Depending how lawmakers design those, though, they could tailor them. They could put income limitations, they could put total limitations on the amount of the tax benefit available and really narrow down the cost. So then you wouldn't have to look too hard to find an offset. And really, that's the kind of stuff I wish we would be seeing from Congress already. But so far, we're close to 100 days into this administration, into this Congress. We've really seen the debate center around procedure and politics and not even delve into policy yet. So those are questions Congress needs to answer and needs to answer quickly, because the deadlines are coming for, decisions on what to do on the tax bill, decisions on what to do as far as the debt ceiling goes, and all of that is wrapped up into one legislative vehicle right now.
Talk to us about enforcement, Erica. A big part of the narrative today, whether it's true or not, is that tax cheaters will have an easier time, and maybe some taxpayers will become cheaters because it's getting easier to pull a fast one on the agency. Is that real or not?
Potentially, we don't really know. I would say one of the best ways to raise tax revenue is to raise the revenue that should be paid right now. So rather than lifting rates, rather than creating new types of taxes, making sure that people pay the taxes that is due is a really good way to raise revenue. We don't really know how this firing at the IRS, this workforce reduction, is going to play out. But I would say one of the things that it threatens is what you just said. People lose faith in the system. People distrust that their neighbors are paying their taxes, so why should I pay mine? That's not the type of vibe we want to create around taxes. We want trust in the system. We want transparency in the system. And really large workforce reductions without complementary simplifications to the tax system don't go in the right direction. You shouldn't significantly reduce the IRS workforce if you're still maintaining a really complicated tax code that has all different kinds of programs run through it. The first step should be dramatically simplify the tax system so there are less opportunities for abuse, and then you can shrink the workforce along with that simplification in the tax code.
And finally, Erica, what factor will tariffs ultimately play in the overall revenue picture, knowing that while the higher reciprocal rates are paused for 90 days, there is that 10% global baseline, 145% now effectively on Chinese imports, autos, steel, and aluminum. What's the net effect of all of that?
Right now, we've estimated that it will raise somewhere in the ballpark of $150 billion to $170 billion this year in 2025. That is highly uncertain. It's uncertain because the tariffs are really on again, off again. You only get revenue if they're on. If they go off again, you don't get that revenue. They're also subject to other types of uncertainty, like if Congress decides to challenge the president's authority, if those authorities get challenged in court. And are struck down. That could be another reason that revenue goes away. But ultimately, even with all of the tariffs that the Trump administration has outlined so far, it doesn't come close to paying for even extension of the Tax Cuts and Jobs Act, not to mention all of the other tax cuts they want to add on top. So right now, falls short of paying for tax reform, is highly uncertain, and is very economically harmful. So isn't even a good way to try to offset the cost of tax cuts, because you're probably harming the economy more with a trade war than you're helping it with the tax bill Congress is considering.
It's like a holiday for you, Erica. Is this Christmas morning at the Tax Foundation?
I need a holiday after this day.
I bet you do. I appreciate your joining us on what must be the busiest day in your world. Erica York, the Tax Foundation, where she is Vice President of Federal Tax Policy. He's not going to be talking about the IRS when he's speaking nationally in Chicago later on, Kailey, but another agency that we've been talking about today, and that is Social Security, the return of Joe Biden, something we'll be talking about later on.
Yeah, he's going to be speaking around the time of the late edition of Balance of Power, his first big speech since leaving office back in January. I guess the question is, while Democrats may like his message, are they happy with him as the messenger? That's
true. We'll find out together. That's around 5 p.m. We'll be watching. Our panel's next on Bloomberg.
This is Balance of Power, the early edition, just after 1:20 p.m. Eastern time here in Washington. It was roughly around this time yesterday, actually, that we got news from Harvard University, which, through the lawyers it's working with, rejected a proposal from the Trump administration, which had threatened to revoke up to $9 billion in federal funding if the Harvard administration didn't acquiesce to what the Trump administration would like to see when it comes to DEI, hiring practices, admissions practices, anti-Semitism efforts as well. And we learned last night how quick the White House was to react to that, with $2.2 billion in federal funding now pulled. And the president today, Joe, threatening to take things even further.
Along with a $60 million contract. This is pretty remarkable and maybe not much of a surprise to those who have been following this story. Some of the reporting had suggested that Donald Trump would like to see this happen to any number of Ivy League schools. It's something we've talked to our panel about quite a bit, and they're with us now. Rick Davis, partner at Stonecourt Capital, a Republican strategist, alongside Jeanne Zaino, Democratic analyst and senior democracy fellow at the Center for the Study of the Presidency and Congress. Did this need to happen, Rick? I think it's something that you saw coming.
Yeah, look, I mean, this administration has been after what they call woke universities. They see it as a core culture issue in their agenda. And they're going after these universities, both public and private, under the guise of attacking the university's acquiescence to anti-Semitism, which I think they think is universally acceptable. But they're really, in essence, trying to gut the DEI programs and other more liberal efforts on these university parts in their curriculum and in their personnel. So it's a pretty significant war on education. And right now, I would say Harvard has at least struck out to be one of the institutions, one of the few institutions to really decide to pick a fight with the federal government.
Well, and we're seeing what the consequences of that fight may turn out to be. Again, Jeanne, $2.2 billion of multi-year grants frozen as a consequence of this, with the president today on True Social suggesting that Harvard's tax-exempt status may need to be looked at as well. You obviously exist in the higher education universe. Can you just describe for us what the actual consequence of that will be for Harvard, for the research that is done at Harvard, in addition to just its educational mission?
Yeah, I mean, ultimately, there would be a chilling effect. I mean, we can't forget Harvard gets $9 billion, which is a staggering amount from the federal government, and they are the wealthiest university in the country, if not the world. They have a lot of resources. Unlike many universities, they have a huge endowment. So they can take this fight to the administration. The problem is, if Harvard doesn't, nobody else can do it. And so, you know, there are implications for higher ed across the board. But the reality is that we are either a nation of laws or a nation of one man. If we are a nation of laws, you follow processes and procedures. You follow the law. And that's the problem here. There is a law in place, Title VI. It lays out that federal government can give funding to these universities, public and private, provided they're not discriminating. So the anti-Semitic portion of this is exactly right on the part of the administration. The problem is they have gone overboard if you look at their demands on on Harvard and other universities, where they are trying to decrease freedoms, academic freedom, freedom of speech, cancel DEI programs, curriculum, and the rest. And that is outlawed in this law. So if Donald Trump wants to take this fight on, he needs to do something he doesn't want to do. Follow proper procedures, go to Congress, get Title VI rewritten, and pass that law with Congress, and then you have the law behind you. But as it stands now, he does not have that behind him. And that is the root of the problem with everything we're seeing in this administration. He doesn't want to follow procedures. He wants to follow Donald Trump's whims.
Rick, I know Harvard called this illegal activity, but was there a better way for the university to handle this? Maybe acknowledge some of the points that the White House was asking for, maybe, categorize them differently than the others. There was specifically a request for the university to report foreign students who commit conduct violations to federal authorities. Is there something here that Harvard could have done differently?
Yeah, sure. I mean, there are always things these universities can do to fit into this concept that the Trump administration is promoting, and other universities similar to Harvard, Columbia, Penn, others have basically worked out arrangements with the Trump administration to continue to get federal grants and federal aid, by adjusting some of their criteria as to how they run their universities. And I don't think there's any doubt that there are questions that have been raised as to how these, especially these Ivy League universities, conducted themselves, how they were managed, how they made decisions, who they hired, were major issues in the summer of last year when you had basically riots on these campuses promoted by agitators in advance of the Palestinian issues. And I think that it opened the door to this kind of criticism. But there are some people who think Columbia did the right thing by working on a deal, maintaining their financial support by the federal government, and at the end of the day probably did not lose the construct of who Columbia is, what they teach, and how they act. So there are universities that are taking a different route, and it's kind of hard to decide right now whether or not Harvard's taken the right approach or Columbia took the right approach.
Well, and I guess that raises the question, Jeanne, if you expect more higher educational institutions to follow Harvard's path or Columbia's?
You know, it's a really difficult choice because most universities do not have the resources that Harvard has. And you see the two conservative lawyers they have hired, well respected, one of whom Representative Steve Bannon and many of Donald Trump's friends. So Harvard knows how to fight this fight. But the reality is Columbia is in a problem because when you capitulate to this type of illegal and bullying behavior, then you are left with the kind of chaos that Columbia has been left with at the top of its board. And so Donald Trump can do this and Congress can do this, but you've got to do it properly. It is funding by Congress. They need to change the title. They need to change the legislation. And then Donald Trump needs to follow proper procedures. But we can't live in a country where you give a grant, which is like signing a contract, and then because somebody new comes into the presidency, pull that back if they don't meet demands. Republicans would not like it if Joe Biden or the next Democratic president does it, and Democrats don't like it. So the reality is you've got to be agnostic. We are a country of laws. Follow those laws. And it's particularly important when it comes from the president. And it's sort of a running theme throughout everything we've been talking about is a president not want to follow procedures, but his own whims and interests. And that is not workable in the United States if we're going to maintain a rule of law society.
Rick, you know that Harvard is an easy target. And as somebody who used to live right across the river in Boston, it receives criticism nowhere more than in its own backyard. Is this good politics in the end for Donald Trump?
I think it's probably good politics for Donald Trump. I mean, every day that he gets to go out and say that Harvard was receiving $9 billion of taxpayer assistance when they have an endowment of over $50 billion, doesn't make sense to most voters. Why in the world would we give federal dollars, our taxpayer dollars, our money as voters to a private university named Harvard, which is beyond exclusive and out of the reach of virtually every American citizen across the board? It's a select few that get the benefit of a Harvard education. And so I think on the surface, it is a very difficult issue for Democrats to claim foul because, once again, they'd be out there pitching for the, liberal Northeast Ivy League institutions, by the way, well represented in the Trump cabinet and White House. I mean, there are a lot of Harvard grads in Congress and in the White House. And so, but you don't hear any of them stepping forward and complaining about this. So how much of this is legal, how much of it is policy, I think is the debate that we're into now. But the optics for Republicans, they can fight with Harvard all day long, and they're not going to lose any votes, and they may pick up a few as they go along.
Jeanne, I want to return to the point you were making about this president in particular not necessarily being the most in keeping with procedure or with the existing legal system as we know it, because that is what will be in focus today. As there's another hearing in the Kilmer Obrego Garcia case, of course, the El Salvadorian who was deported to El Salvador, which the administration admitted was accidental. We all watched in the Oval Office yesterday when both the Trump administration and the president of El Salvador said neither of them have the power to return him back to the U.S., even though the Supreme Court has said that must be facilitated. Do you see this ultimately ending in potentially contempt of court proceedings for these officials that to this point have been largely stonewalling the judge overseeing this case?
Yeah, I don't know if we're going to see that, because part of the problem is the Supreme Court left a hole that the administration could drive a truck through. You know, facilitate as a return, but explain to us what you mean by effectuate. And oh, by the way, defer to the White House on foreign policy. And we've seen Stephen Miller, the president, and others take wild advantage of that. And so I don't know that it's going to end in contempt. We may see some of that. But I think the reality is it is disingenuous for both Bukele and Donald Trump to sit there and say we can't return this individual. And by the way, if he's returned, they can deport him legally following the laws within hours. But it's disingenuous for them to make that argument, considering we saw them already return 9 people. And so once again, Donald Trump does not want to follow proper procedures. You messed up, admit it, send him back, then deport him again, but do it in the proper way. And by the way, don't cavalierly in the White House giggle as you talk about sending Americans down there as well. It is flirting with something we haven't seen in over 250 years of this country. And it is a rule of law country, and he, as the president, knows better.
All right, Jeanne, Zaino, and Rick Davis, our political panel on this Tuesday. Thank you so much for joining us. And we still have more ahead here on Balance of Power as we turn back to tariff policy and the intersection with markets. That's next on Bloomberg TV and radio.
Thanks for being with us here on the fastest show in politics, Balance of Power, live from Washington on Bloomberg TV and radio. You can always find us on YouTube as well. Search Bloomberg Business News Live. We're going to have a conversation as we stick with the markets here for a moment with Eric Freedman, Chief Investment Officer, U.S. Bank Asset Management. With Kailey, the idea of uncertainty driving things for better or worse. Here we've apparently flattened things out for the most part today. It's not really a session to write home about, but when you consider the impact on the markets that we've seen over the past couple of weeks when it comes to tariffs specifically, it's hard to overstate how powerful this has been.
Well, including the power to change Trump's mind about reciprocal tariffs, at least to a certain degree. As he noted last week, queasiness in the bond market and people getting yippy, and then announced the 90-day pause on the higher reciprocal rate for most countries. And of course, we understand that instrumental in helping the president make that decision were Wall Street voices within the administration, like the Treasury Secretary, Scott Bessent, who of course used to run a hedge fund, Key Square Group. And there's those kind of voices all throughout Republican politics. Commerce Secretary Howard Lutnick, formerly of Cantor Fitzgerald, I guess you could include in that as well. But another is actually the governor of Virginia, Glenn Youngkin, of course, used to be at Carlyle Group. And he joined our colleagues on Bloomberg Surveillance earlier today to talk about the policy and financial market bridge and the impact of tariffs overall.
The net of it is that President Trump was clear. He's continued to be clear that in resetting bad trade deals over the last decades and reestablishing reciprocal trade opportunities, by the way, with nations that are our allies, China's a whole different topic, but with nations that are our allies, we just need fair trade, and we haven't had it. And so, to reset those trade imbalances, you see him do what he does well, which is create space for negotiating. And I think that's exactly what's happening. When the first weekend after April 2nd, you read in every publication that 75 countries had called within a day to start the negotiations, and you've already seen those negotiations, at least reported in rumor, I think this will be this opportunity to take a big step in resetting this.
Hold on a
and
second.
I think that's what the market needs to see.
Part of the problem, I think, and you know this very well, having invested heavily as a co-CEO of Carlyle and been investing in infrastructure, which takes a long time, there's a maturity mismatch between when some of this negotiation is happening, when these tariffs go on, and how long it takes to bring that investment to the United States. There is a lack of clarity about whether those policies will be continued in perpetuity, and it's leading to paralysis at so many companies. What do you tell the companies in your jurisdiction who come to you and say, how can I plan? How can I hire? How can I invest when this could change, when I don't even understand the parameters we're talking about?
Yeah, I have to disagree with you on the long-term planning, because we're seeing a pipeline of economic investment that has been as full as it's ever been. And these are long-term investments. Fortune 50 companies wanting to build in America and in Virginia, hopefully, if we can recruit them there. And these are long-term investments. And you saw NVIDIA yesterday talk about $500 billion. We've seen most of the big pharmaceutical companies commit to building in the United States. We're seeing technology investment, advanced manufacturing, all in the United States. These are long-term investments. I think the difference in a lot of people's understanding is that during market ups and downs, well, yes, IPOs get postponed, and yes, corporate deals get postponed, but these long-term commitments are actually coming in very large numbers, and that's good for states like Virginia. I mean, listen, we're in the SEC of economic development. I compete every day with Tennessee and North Carolina, South Carolina, Georgia, Florida, Texas. And we've got to compete. And I think that much of that investment will come to this region, and that is a long-term commitment.
The governor of Virginia, Glenn Youngkin, speaking on Bloomberg Surveillance on Bloomberg TV earlier today, speaking to the veracity of long-term investment here. There's a big question when it comes to what near-term investors are doing, whether it's stocks or bonds. That's why we wanted to spend some time with Eric Freedman, with our eyes on the markets here on the Politics Show. As I say, you can't separate them. He's the Chief Investment Officer, U.S. Bank Asset Management. Eric, great to have you. Welcome to Bloomberg TV and radio. You write that we've shifted from a glass half full perspective to a glass half spilled perspective. So how do we get the water back in the glass?
Yeah, I think it's a analogy that we're using more often than we'd like right now. And really, we look at this from a very apolitical lens from an investment standpoint. You all do a great job of covering both sides of the aisle. We have to think about this in terms of buying and selling. And ultimately, we really think that getting the water back in the glass really sits with the idea of what is the objective function we're trying to solve for here. And I think you've heard, including the governor's comments that you just played, this notion of the long-term economic plan. And that certainly is of interest to us as investors. But we also have to invest in something that's open, seemingly 24/7, which is the global capital markets, which aren't necessarily focused too much on the long term. So for us, really the key is, what is the spectrum of choices the administration wants to solve for? And is it partial reshoring? Is it more full reshoring? Is it just a more level playing field? Because there's so much nuance in what that objective function might be. In the meantime, we have to really focus on what is the actual economy doing. And that for us is probably the time difference between where we are right now and when some of these longer term, projections may actually come to play.
Mm-hmm. Well, and to your point on what will the economy be doing in the shorter term, as the administration, Eric, has talked about short-term pain, we got a take on what that pain actually could look like, or the probability of pain, from David Kostin, the chief equity strategist over at Goldman Sachs. This is what he told our colleagues on Open Interest this morning.
Well, certainly there's a high degree of uncertainty. Largely that's around the policy of the exact nature of the tariff and the likelihood or not whether there'll be a recession. And our economists here ascribe around a 45% probability of recession in the next 12 months. So the base case is, in fact, not a recession. The economy continues to grow.
Is a recession in your base case, Eric?
It's not, Kailey. I think it's a great clip to play. And if you think about what I'm going to call, to bring in your colleague Tom Keene for a second, this now becomes a y-axis problem for investors like us, meaning what is the time difference between right now and resolution. So we felt coming into, the pre-April 2nd period that the economy was certainly slowing, but still in a good spot. We had estimates, and we were about a 10% estimate growth for the S&P 500 in terms of earnings for this year. That's probably going to come down to something more flattish, if even, potentially negative. So, as you have more time that goes on, we actually have more vulnerability, particularly with middle income consumers. That was the most vulnerable consumer set heading into the April 2nd news. This was a group that's done okay from an employment standpoint, has done okay with respect to wages, but we think we avoid recession as long as we get that objective function clarity. Let's call it in the matter of 60 to 90 days. If this goes past the current pause to tariff deadlines, that's where we could see consumers really starting to question the end game here. So I think that, again, this notion of the economy will likely be able to endure this uncertainty for a period of, let's call it 60 to 90 days. More than that, that's when you have both businesses and consumers really questioning what they should do. And when businesses and investors think about questioning, if you will, they pull back. They don't double down, if you will. So that's why we think we'll avoid a recession. But again, this y-axis problem is in the administration's hand right now.
Well, without getting into Tom Keene's triple leveraged cash, I do wonder if you're waiting with your own money here. Is it 60 to 90 days before you put new money to work?
We've been saying our clients really fall in three buckets. Bucket one would be those clients who are in, let's call it the right asset allocation for their time horizon. They're fine. They're in a good spot. We have a ton of global exposures that go beyond the bond and stock market, so they're in a good spot. Those clients that have an excess of cash for whatever reason, those clients we've been saying, hey, use this volatility as your friend, be more incremental, piece in. But for those clients that are probably overweight domestic equity exposure, that they've really been riding that wave, if you will, which has not been our advice, but they've been sort of sticking with it. We've been saying, hey, this is an opportunity on big up days to reduce and broaden out. So we don't think we have to wait 60 to 90 days for this to be fully resolved. But some inklings, again, you did a great job reporting on this earlier. The European Trade Union lead negotiator is also unclear about what the end game is. We need more concrete messaging about, hey, we're on a path towards resolution here. Until we get that, we think this back and forth likely continues. We'd be concerned if the S&P retested that 4,800 level, which again we saw on Monday of last week.
Yeah.
We think we're going to grind it out between 4,800 and probably 5,600 in the S&P for some time. The 10-year, again north of 450, 460. That becomes a little more of a concern on our radar screen, but we think we probably live in those ranges in the immediate term. But again, that resolution and a path towards outcomes is what we're looking for to get more comfortable with putting fresh money to work here.
Well, and it's interesting to hear your comments on kind of cash allocation, knowing we got the latest Bank of America fund managers survey today. And the strategist led by Michael Hartnett there said they do not see peak fear yet reflected in the market or in cash allocation, which currently stands at about 4.8% of assets. They say they see max bearishness on the macro, with actually investor sentiment around economic prospects the lowest in 30 years, but not quite max bearishness on the market. And Eric, if we haven't reached max bearishness yet, words can be difficult at times like these, does that suggest we might actually see a retesting of those lows you were talking about?
Yeah, I think that we haven't seen what I'm going to call that capitulatory action, if you will, Kailey. And so what would that mean? That would mean a really sharp spike in the VIX. That would mean that put-call ratios get highly skewed towards puts. And we see the, hey, let's sell, not what I want to, but what I have to. We haven't seen that moment. We got close to it a week ago yesterday, just with respect to the Monday print, just given a lot of back and forth over that preceding weekend, but we didn't see it. And so that doesn't mean we have to see it. Again, our viewpoint is that if we can live within this range in the 10-year between, let's call it 4 to 475, and again, S&P 4,800 to 5,400 and ultimately 5,600, that to us would be, a level of let's not call it complacency, but that says that the market is okay with these negotiations pressing. We get concerned if we get closer to that 90 days and there aren't signs of more concrete resolutions occurring. And that's going to happen more on the ground. That's why we'll be certainly focused in on what you're reporting, because again, for all the things we look at in terms of data, we're paying a lot of attention to high frequency data. But in terms of how those negotiations actually are going on the ground, that for us is certainly sitting front seat for markets right now.
Just 1 minute left here, Eric. This has been fascinating, and we appreciate your insights here with what you're saying. If I'm reading you correctly, is Wall Street will be dependent upon Washington and specifically tariff policy, maybe for the rest of the year. Do tariffs impact your year-end target? Will you even go there?
Yeah, I mean, we think that this is going to be a case where, just to talk about our earnings estimates, we felt that coming into this year, we thought that, up 10% from a growth standpoint on earnings was more likely. And that put a number on the S&P that was, had a 6 in front of it. We think that probably something with a 5 in front of it is more important, for this year. I would say this just really quickly. Ultimately, this is, a resolvable issue. But we need to see, again, the end game. Is this about isolating China? Is this about, gaining a broader, consortium of non-China countries? And there's lots of spots in between. But again, we think that the markets are not going to wait for tax reform to kick in, which of course you've done a great job of covering. There needs to be some more guidance before we start focusing on tax reform.
All right, we appreciate your kind words and your insight. Eric Freedman, Chief Investment Officer for U.S. Bank Asset Management. And we'll be back for more in the late edition of Balance of Power on Bloomberg TV and Radio.